to the Inspire Wealth podcast with Prof, where we dive into the world of real estate investing and wealth building strategies. I'm your host, Mallory Meehan. I'm a real estate professor, attorney, and seasoned investor here to guide you through the ins and outs of creating wealth through real estate. If you're looking to take your real estate knowledge to the next level, don't forget to subscribe to stay up to date with our latest episodes and offerings. Welcome back to another episode of Inspire Wealth. I am your host, Prof M, aka Mallory Meehan, and today I'm joined by my friend Jeremy Dyer. Jeremy, welcome to the show.
Mallory, thank you for having me.
Jeremy, I'm really excited to do this. I know we had met virtually a few months back, and I'm really excited for you to share what you've been up to because I get your emails. I get, kind of some of the projects that you're working on. But before we dive into that, Jeremy, why don't you give everybody a little bit of background about how you got into real estate, what you're working on, and then we'll dive in.
Yeah, I would absolutely love to do it. So thank you for that opportunity. So, I'm a recovering sales professional. I was in the sales tech space for 25 years, very blessed early on in my kind of sales journey, coming right out of college, hitting the ground running, ended up being the number one guy in all of North America within my division by year number 2. Rode the commission checks, rode the bonus checks, life was good. I was a high income earner. My wife and I had our dream home paid off by the time I was 24 years of age.
Oh my God.
Had the 40-foot RV sitting in the driveway, completely debt free, maxing out the 401k by the first quarter of every calendar year. Things were good. But we also had a strong desire to diversify outside of Wall Street and into Main Street. And when it comes to investing in Main Street, you're either doing something like buying into a franchise business, building up your own small business, or finding something that you can invest into on the passive side, right? Whether that's through maybe like an angel investment or a private placement real estate syndication. If it's real estate, well, what asset class, right? All those types of things were things that we had to consider. So at the time, this is back in 2012 now, my wife and I decided we're going to try our hand at fixing and flipping houses. Why? Because it seemed super sexy on HGTV. And we thought, hey, if they can do it, we can do it, right?
Exactly.
The other thing is we already had a team ready to rock and roll. My dad had a general contractor's license. My wife stopped working when our first child was born, which was back in 2007. Okay. And I just happened to have plenty of dry powder on the sidelines. So we had this kind of team already ready to rock and roll. And we were really entering into the space at a good time in the market cycle, right? We were kind of coming out of the global financial crisis. Do I wish that I had been buying houses in 2008? Yes. Okay. But I got started, cut my teeth in 2012. So we were fixing, flipping houses. Things were going well. I've got great stories and I've got horror stories, right? The horror stories, everybody wants to hear about those, right? I'll never forget, taking my kids, out looking and shopping, distress houses to buy. We'd see anything from marijuana labs to meth labs to stripper poles. We pretty much saw it all, right? And it just got to this point where I told my wife one day, I said, listen, I'm riding 2 horses at the same time. Okay. I'm working 60 hours a week, grinding out the commission checks and the bonuses, hitting my quota. And at the same token, we're also building up this single family homeownership portfolio, which was really going well. The challenge is we were going to have to go from flipping, 4 houses a year to flipping, 40 a year. We were going to have to go from, owning and actively managing a half a dozen to like 60 of them, right? We had to scale in order to completely replace the dependence that I had on the W-2 income, right? And so the other thing that happened, Mallory, is 2015, my wife and I decided to double down on kids. When I say double down on kids, we went from 2 kids to 4 kids. If you're reading between the lines, numbers 3 and 4 were twins, right? And so it just got to the point where it was a bandwidth issue for me. I told my wife, Marlene, I said, I can't be working 60 hours a week, crushing the commission checks, building up an active portfolio of single family homes, fixing and flipping, and trying to be a good husband and a good father all at the same time, right? Mm-hmm. So 2015, we decided to step off of the active fix and flip side of the business. we decided to become passive investors in what's called a real estate syndication. Most of your audience is probably familiar with that terminology, right? So we became passive, limited partner real estate investors, right? I networked my way into several sponsor groups that I knew, I liked, I trusted. I did my due diligence, vetted them out, deployed capital with those operators from that point now till today. Okay, so I'm taking you from 2015 to 2025, a decade later, right? My wife and I have had several deals that have gone full cycle. We've lost 100% of our money on deals. We've had capital calls with some of the deals that we're in. We've had a lot of deals that have been home runs, grand slams, right? We've seen it all. We're actively right now in 40 deals as limited partner passive investors, and I'm not stopping. In fact, right now, where we're at in the current economic market cycle, I'm doubling down on the strategy. Okay. Why? Because I invested in a number of deals at the peak of the market, which was 2021, early 2022. Now we're in a downstroke. It feels a lot like it did back in 2008, 9, and 10, although I don't think it's going to get quite that bad, but it feels a lot like that right now in the current economic market cycle. So we're going to continue to deploy capital. And Mallory, as I told you before, I'm a recovering sales guy, so I always have a lot to say. So I'm going to turn the mic back over to you.
Oh, I love it. Okay, so that was a lot to unpack. And I love that you have such a broad experience. And I think a lot of people, when they're first starting out in real estate, the fix and flip is just kind of something that is easy to get into, right? You have low barrier to entry, and HGTV makes it look super sexy and super easy. And you're going to make $30,000 on your first flip, and some of these other things. But so before we dive into the syndications, I'm curious as to how many properties you had as an active investor when you decided to make that transition to passive income, and what was your strategy for your disposition of those properties?
Yeah, great question. So at the time that we made the decision to exit, okay, we had just gone through a 12-month grueling process to adopt twins from Wuhan, China. Okay. So I didn't tell you this before, but those numbers 3 and 4 twins, they were adopted from Wuhan, China. So we went through a grueling 12-month, what's called home study, both domestic and international. And we were already in the process of winding down. Okay. While we were in Wuhan, China, okay, I'm way on the other side of the world, right?
Yeah.
I get this phone call. Okay. We had the last property ready to exit, ready to sell. Okay. We were set to make $90,000 in profit on this flip. Okay. I get the phone call from the real estate agent while I'm in China. Okay. Saying, Jeremy, the inspection report came back. The septic failed. The well failed. They need to be replaced in order for the transaction to go through. Okay. That cost me $35,000 in profit to replace the well, the septic, and the landscaping that went with it. That was like the straw that broke the camel's back. At that point, I'm now paying myself minimum wage, okay, for the amount of time, effort, and energy that I was putting into that fix and flip. I told my wife, I'm done. Okay, I'm going back to the W-2. I'm going to focus just on my day job. I'm going to coach, our kids' hockey teams, baseball teams, lacrosse teams. Like I'm going to be a full-time dad in the evenings, a full-time dad on the weekends, right? Like enough with that dream. I scratched that entrepreneurial itch. I scratched my real estate itch. We're going to stay in real estate. Okay. We're going to keep that capital deployed in real estate. I'm just doing it through a private placement real estate syndication as a limited partner investor. I'm going to deploy my capital with best in class sponsors and operators going forward.
Okay. So the proceeds that you made from all of your fix and flips, did you do a 1031 exchange into the syndication, or did you end up paying capital gains and then deploying it?
Great question. I paid the capital gains and I moved on. Yeah. And obviously, as most of your listeners probably know, and you do too, as a passive limited partner investor, there are still tax benefits, right? So even though, I was paying capital gains taxes on the sale of those flips, right? I was still deploying and keeping that capital in real estate. I talk about this as a lazy 1031 strategy, right? There's the traditional 1031 and there's a lazy 1031. So I'm still able to leverage as a limited partner passive investor. I was still able to receive the benefits. However, the benefits of the tax depreciation could not be applied to offset my ordinary income because at the time, neither my wife nor I could qualify as real estate professionals and check that rep status box, right? Since then, we are able to do that, okay? But at the time, I was not able to leverage, that. But still, all the passive depreciation, I'm sorry, all of the distributions that we receive and the equity profit splits that we receive as passive investors, we're able to leverage those passive depreciation losses to help offset those capital gains taxes through what I call a lazy 1031 exchange strategy, which, by the way, most investors have to go that route anyways, because most investment sponsors, they have minimums for 1031 exchange money, right? Some sponsors, it's $1 million, right? Some of them it's 500 grand. Some of them it's 250K, right? Well, oftentimes people don't have that amount of proceeds coming off of their what's called their relinquished property, right? In order to be able to leverage to invest into the replacement property. And so they need to execute that lazy 1031 strategy instead.
Yeah, that makes total sense. Okay, so I really want to dive into syndications with you because you're kind of like the king of syndications. And so let's talk about when you first got into syndications, and then we'll transition into your role that you're in now and the capital projects that you're involved in so that our listeners can really understand how to evaluate this as an option for them versus maybe going the flip and fix or the fix and flip route or true rental route.
Yeah, no, I'm glad that you asked that question. And I got started using what I call the shotgun approach. Okay. I
Okay.
held my breath, I plugged my nose, and I hoped for the best. That's truly how I got started as a limited partner passive investor back in 2015. Okay. The truth is that I didn't even know what the word syndication really meant, other than the fact that I knew that the Green Bay Packers were a syndicated football team. Beyond that, that was like the extent of my knowledge of what syndication is.
Sure.
Back then, if I looked at the pitch deck, I'm like, well, this is exactly how the investment's going to perform, right? Now I
Of
know
course.
that's not the case, right? Now I know that there's a major difference, okay, in the jockey that's riding the horse. The horse is the asset, okay? I don't care what asset you're talking about. It could be multifamily, could be self-storage, retail, flex office, you name it, right? There's all kinds of different asset classes. I mean, I've been invested in a marine park, right? Marina, right? That's what I'm in, a marina. But there's RV parks and all kinds of different things that you can get involved with. So you're not investing in that deal. I'm sorry, in the property. You're not investing in the pitch deck. You're investing in the operator and their ability to execute the business plan. So you're really executing an investment in that jockey, and they're not all created equal. Okay. Some have varying degrees of experience. Some are brand new in the business. Some have teams of 2, some have teams of 200, right? Some have impeccable track records. Some don't have a track record at all, right? So you really have to understand there's a very big difference when a limited partner passive investor is looking at, do I invest in deal A? Do I invest in deal B? Okay. It's not just about the market timing, because that's important as well, right? Everybody was running into the fire in 2021 and they shouldn't have been, right? Now there's fear, there's blood in the streets, and it's hard to raise capital in this type of an environment. But if you follow Warren Buffett's rule, now's the time to actually start getting in the game again, which is why my wife and I did so well, having invested on the back end of the global financial crisis, because we were still able to acquire single family doors at a good basis, right? And that's really where we are right now in the economic cycle. So my feedback to folks is like, listen, okay, if you have investment A and it's projecting a 16% internal rate of return, and you have investment B that's projecting a 22% internal rate of return, it doesn't necessarily mean the outcome to investment B is going to be greater than investment A, because those sponsors are just merely making projections. And there's a lot of different ways that sponsors stress test the financials. There's a lot of ways in which you can manipulate an underwriting spreadsheet to make a deal look great or make a deal look not so good, right? But all at the end of the day, it's not always a numbers game. It's about that sponsor and their team's ability to execute whatever the business plan is. The business plan that we're most familiar with is the value add multifamily. Buy a multifamily property that's got 100 to 500 units in a B plus class neighborhood, workforce housing demographics, safe, affordable neighborhoods. But the property was built in the 1980s. Okay. And almost all the interiors are classic in nature. Right. And so we're really looking to take that 1980s vintage multifamily apartment community and fully renovate all the units to a scope in which the local tenant base is comfortable with, number one, and can afford, number two,
Mhm.
right? Because
Right.
if the local tenant base can't afford $150 per unit rent bump, then the business plan is going to fall on its face, right? And so
Right.
there's a number of different ways that we kind of assess that. But for your listeners, it's more important to not focus so much on the shiny pitch deck, right? And it's more important to focus really on the operator. And the truth is that the role that I'm in is I've invested with dozens of different operators. I have had the pleasure of speaking to some very large real estate audiences. The best ever conference, for example, this year had me as one of their main stage speakers, right? I had the pleasure of authoring my own book called The Fundamental Investor, which I'll show you here. And this is just chocked full with how to properly evaluate not just an investment, but how to properly do your due diligence on the operator, right? The sponsor who's actually the jockey that's riding that horse.
I love that. That's awesome. Okay, so you had first started out investing in syndications where others were the sponsors. And so the sponsors are essentially the general partners. They're the ones who are out there finding the opportunities, finding the deals, getting them under contract. And then all of the limited partners are those that are contributing capital, and that's pretty much their contribution. So tell me about how you made the transition, because I'm assuming that you're no longer in sales. Is that a correct assumption?
Yeah, it's a fair assumption. So I'll maybe kind of fill the gap in because
Okay.
if you heard me what I said before, I basically fast forwarded from 2015 to 2025. So I left a
Yeah.
decade out, right?
Yeah. Right.
So what was happening over the course of that decade is I was still grinding out the commissions. I was investing more and more capital into real estate. Truth be told, I was crushing the commission checks just so that I could come up with another $50,000 to put into another deal. Okay. And then as deals would go full cycle, I would implement either to the traditional 1031 or the lazy 1031. I would basically stack these deals on top of each other. All the monthly distributions I would receive would go into a money market account. Once that money market account hit 50,000 bucks, I'd have an extra 50 grand to stick into the next deal. So compounding is like the eighth wonder of the world, right? So
Mhm.
I continued to do that over time. What was happening is that my wealth trajectory was going like this, okay? While my 401k was just keeping up with inflation, while my Wall Street investments were just barely keeping ahead or in line with inflation, my real estate investments were growing exponentially. And I told my wife one day several years ago, I said, Marlene, like we're almost seven-figure income earners crushing the commission checks. And someday I'm going to make more money in passive income than I'm currently making in active income. Right. And so I started to see that in my own personal wealth building journey. And then, of course, when that happens, you just want to tell people, right? So I
Absolutely.
was telling family and friends and neighbors and people that we go to church with, and certainly people that I work with, my professional network, right? And all of a sudden, lo and behold, I'm not alone. Like everybody else wants to get in on these deals with me too. So I would evaluate an opportunity. I already knew, liked, and trusted the sponsor. Heck, the sponsor in some cases had multiple six figures of my own money. So I really know them, right? Because
Yeah,
I'm in
right.
those deals already. So
Yeah.
when they have a new deal or opportunity, they obviously send it to their investor network. I'd evaluate it. If I was willing to stick 50 or 100K of my own money into that deal, then I said, hey, you know what? I'm going to tell my buddies about it, right? I'm going to tell
Yeah.
other people on my network. Well, lo and behold, that blew up. Okay. When I say that blew up, it blew up to the tune of, I was bringing in check sizes of 2 to 7, $2 to $8 million per deal from people that are part of my own personal professional network. This wasn't me bringing just my money into these deals. This was me bringing my money in, plus I was bringing 60, 80, 100 other people with me, right, into these opportunities. Well, what's unique about that is when we as a community of investors come into an investment opportunity, that comes with leverage, right? And leverage is an important word when it comes to real estate, as I'm sure you teach about, right?
Yep.
Well, we also now have leverage with the operator. Okay, if the operator is looking to raise $20 million and 5 million of that is coming from Jeremy's network, that's 25% of the equity raise, right?
Yep.
Well, if I'm bringing in a check size that's 25% of the equity raise, I better be getting a better split, right? On
Absolutely.
profits, I'm going to get a better preferred return. We're going to negotiate out an additional split in the waterfall if the deal exceeds, a certain equity multiple or certain IRR, right? And that's effectively what we did. So the operator traditionally will give the investors an 8% preferred return and a 70-30 split on profits. Well, we're leveraging an 85-15 split, okay?
Mm-hmm.
So it enhances my own personal return profile. So selfishly speaking, my own personal cash invested in these deals has a better targeted return profile because of that leverage and that split. But so do the rest of the investors that are coming with me, into that opportunity as well.
I love that. Now, tell me about at what point in time, because you were bringing all of these people into these deals, at what point did you decide or, maybe figure out that, hey, if I'm bringing all of this equity to the table, why aren't I taking advantage of that? Plus your skills with understanding markets and understanding asset classes. So tell me, at what point between 2015 and 2025 did Jeremy decide that he was going to be the one in charge of these syndications?
Yeah, it's a great point. So it was about 2.5 years ago. Is if you kind of think of a franchise owner's journey, that's basically the same journey I took, right? A typical franchise owner is going to decide to invest in Main Street. Then they're going to maybe work with a franchise broker, determine what type of a brand or business model they're comfortable with or where their skills can transfer, right, from corporate to franchise ownership, right? And usually they'll do both in parallel with one another for a while, right? Most Great Clips franchise owners don't rip off the W-2 Band-Aid one day and just become a Great Clips franchisee the next day, right?
Right.
They'll build up through acquisition, through building organic, salon locations. They'll kind of build up a book of business so that that book of business then can effectively replace the dependence on the corporate paycheck, right? And then they'll transition away. Well, that's exactly what I did, right? So I was, still technology sales, Jeremy, and then I was kind of building up this capital raising business on the side, right? I got 2 years into it and it made no sense anymore for me to be crushing the commission checks because I had built up such a large base of investors at that point, where we had that leverage with the operator, the sponsor. And from a compensation perspective, I received compensation through these funds that we set up that deploy the capital with the operator, right? Because truth be told, I actually leverage a 90-10 split with the operator, and we give our investors an 85-15 split. So the investor still wins. They still get a better targeted return profile, a better split. But that's where my compensation lies, is the compensation to me lies in between the 90-10 split and the 85-15 split that we give to our investors. We also have to structure it that way, Mallory, because we raise capital under a Regulation D 506B structure. Okay. So everything that I do, all right, involves a securities attorney, right? And so everything that we do as it relates to how we interact with investors, how we raise capital, how we structure the fund, how we're compensated through the fund, right? Everything all has to be blessed by an SEC attorney, if that makes sense.
Absolutely. Absolutely. I mean, anytime you're dealing with large sums of money like that, it's good to be regulated at some level. So you have now funds. And how many funds are you right now managing?
We have 15 funds that we personally have raised capital into over the course of the last 2 year period.
Okay. So I want to talk about what somebody would need to do and maybe some strategies that you've told some of your network on maybe how do they come up with, some of these minimums, because most syndications are going to be, $50,000 minimums or more. Sometimes they're required to be accredited investors. So talk to me through how you advise some of your network on one, how do they know if they're accredited or not? And two, how do they get large sums of money like this if they don't necessarily have it, quote unquote, in savings or on hand?
Two very, very good questions. And I do talk ad nauseum about this as well in my book. So I hate to plug it again, but the
No, we'll
fund,
leave the link below. And is it available on Amazon?
it's available on Amazon. Again, it's called The Fundamental Investor. Very blessed, by the way, when I launched that book in November last year. It was the number one best-selling Amazon book in the category of real estate investing for a period of about 4 weeks. So I'm
Awesome.
pretty excited about that. So it took plenty of screenshots to kind of prove it later. But
100%.
yeah, thank you. So the accredited investor is actually relatively simple. This is obviously June of 2025. So of course, some of these things are maybe subject to change in the future. But right now, an accredited investor is essentially any individual that makes $200,000 per year, any joint couple that makes $300,000 per year, and when it and or has a net worth of $1 million or more, excluding their primary residence. Okay, so that is an accredited versus a non-accredited investor. Now, we primarily only do 506B, Regulation D investment offerings. What that means is that A, we cannot advertise. Okay, so you'll never see me out on LinkedIn, for example, advertising an investment opportunity because we can't. It violates SEC rules. Okay, however, the trade off is we are allowed to take non accredited investors. Okay. So if we have folks that don't meet that net worth liquidity requirement or they don't make enough per year to qualify as an accredited investor, that's okay. We don't require any proof of income. We don't need any tax returns. It's literally self proclaimed, accredited or not. And it doesn't matter at the end of the day if you are or you are not. Okay. So that's kind of the difference there. As far as where individual investors come up with the funds to partner with us on a project, first of all, our minimums are 50,000. Okay, we feel like that's a good price point to allow most people to get involved. It may not mean that they can get involved multiple times during the course of the year with multiple different investments, but it's a good place for most folks to get started. I do recommend everybody, if you've never made a investment before in real estate as a passive investor, to just invest at the minimum the first time, because you're going to learn a lot through that process as well. I have plenty of phone calls with people that tell me, Jeremy, I've got 100,000 in liquid cash ready to go. If they've never done it before, I say, don't put all 100K in one deal. Okay, let's do 50 in one, and then we'll have another opportunity later on this year that you can diversify into multiple different investment offerings. So where folks come up with the money, obviously liquid dry powder, as I call it, that's the first place. That's the easy spot, right? Some folks do liquidate stock. That is a potential option. We do have some that leverage home equity lines of credit, which I do not recommend with where interest rates are at today. I would have recommended that maybe 4 or 5 years ago, but not today. Okay. We do have a lot of investors, however, that are leveraging their old IRA dollars. Okay. So if you have IRA funds from a previous employer, for example, or you've been contributing to a Roth IRA, for example, there's something called a self-directed IRA, which you could leverage, which effectively means that you would need to establish an account with what's called a self-directed IRA custodian. There's a handful of good names out there. Most of our investors use one by the name of Madison Trust. Okay. So you set up an account with an SDIRA custodian, and the SDIRA custodian will transfer the funds from your existing IRA into your self-directed IRA. And then that self-directed IRA is what deploys the capital into one of our future investment opportunities. When we produce monthly distributions, then those monthly distributions flow directly back into your self-directed IRA, because you can't take possession of those funds until the time is right to do that in the future. And then when the investment goes full cycle, so when we split the profits at the time of sale, most of our investments have a hold period of 2 to 5 years. So when that investment opportunity goes full cycle, or maybe you do a cash out refinance, those funds then go directly back into your self-directed IRA, and you can then deploy those funds into one of our future opportunities to keep that cash moving throughout the system. I always like to tell folks, when cash sits still or stagnant, that's when it loses money. When cash is moving through the system and accelerating through the system, that's typically when people do better. Of course, obviously, there's bad investments, good investments, that type of
Yeah,
thing, which you definitely need to take into consideration as well.
absolutely. So tell me a little bit about your current deals that you have, and how you generally, promote, if you will. I guess I don't want to use the word advertise, but promote the opportunities, and how frequently are these opportunities coming up that people can get involved?
Yeah, it's a great question. So our cadence has been about 8 to 10 per year. Okay. So about 8 to 10 new investment opportunities we're going to have available to partner with investors with on an annual basis. I can't guarantee you that's the future because again, we underwrite 100 deals before we put in an offer on one, right? And sometimes stuff just doesn't pencil, right?
Yeah.
We've had a lot of investors say, hey, I'd like to invest in, Orlando and Tampa. Well, there's nothing penciling there right now.
How
Or
much
we'll have
insurance costs?
investors, yeah, or we'll have investors say, hey, I'd love to invest in a Phoenix property or a Tempe property. Nothing's penciling in that market, right? Nobody's selling. Okay. Transaction volume fell off a cliff. And even if somebody was selling something, it doesn't fit our buy box anyways, right?
Right.
So there's certain markets that we focus on. We primarily like the markets of Dallas, Fort Worth. We really like Charlotte, North Carolina. We like some of the tertiary markets out there as well, like Greensboro, the Triangle Park area, Raleigh Durham, Chapel Hill. So those are the markets that we focus on. Those are the markets that we have local boots on the ground as well. So we've got an internal, we're fully integrated in-house, right? Everything's in-house when it comes to property management, building maintenance, building construction. We have our own GC license, right? The community managers all in-house. Everybody's in-house. So we can really control that timeline from acquisition all the way through disposition. We don't have to worry about, a bad third-party partner, right? Because
Right.
they're our own in-house staff, that are executing, that business plan. I probably mentioned this before, but again, we're primarily interested in targeting that workforce housing demographic. If you
Mhm.
look at times of economic expansion, you look at times of recession, that demographic is by far the most resilient. Okay. That B class asset. Okay. Again, safe, affordable neighborhoods, right? We don't target low income C class or D class, and we do not target A class or luxury class either, right? That B class is kind of that sweet spot,
Mhm.
right? Where during times of recession, you might have people moving from A class down to B. During times of economic expansion, you might have people moving from that kind of C class to B class.
Yeah, absolutely. Okay, so those are kind of your primary markets that you're focused on. Now, are you then exclusively workforce housing, or have you gone outside of that buy box at all? And if so, what asset classes does that look like?
Yeah, it's a great question. So actually, it's kind of two different answers. Okay, it's what does Jeremy invest in, and what do we do as a sponsor, a syndication team, right? What we do as a
Give
sponsor,
me both. Give me both. Yeah.
yeah, I'm definitely going to give you both. So on the syndication team, on the Jeremy, partnering with investors, raising capital, it's B plus class, workforce housing, multifamily, 1980s, 1990s vintage with a value add, forced NOI growth, buy and hold for 2 to 5 years, exit as fast as we can, roll that money from a 1031 exchange into the next deal. Okay. So it's a fairly small, it's actually, honestly, it's a boring buy box. Okay. It's not a sexy business model, but because we've done it so many times, it's such a rinse and repeat for us, right? We have a team that understands the process. We know we can execute. When you talk about having to renovate, in some cases, 350 units in a 2 year period, like that takes a whole team. Okay. That's not
Right.
easy, right?
Right.
It's also not easy because there's lots of headwinds. Well, what about, tariffs and, the cost of materials going up? How's that going to affect your business plan? There's insurance costs and taxes, considerations and all these kind of headwinds, right? I always like to say that in real estate, you'll appreciate this because you teach it. Birds fly, fish swim, real estate falls apart. It's just what happens. Okay? Welcome to real estate, right? And that's
Yeah.
why you're betting on the sponsor, you're betting on the general partner,
Right.
you're betting on the jockey, the airline pilot, all those different, analogies.
Right.
Now, Jeremy Investor Hat is different. Okay. And I write about all this stuff in my book too. Jeremy Investor's Hat is very diversified. Okay. So I've invested in RV parks, marinas, self-storage, flex office, industrial, retail, multifamily, A, B, C class, build to rent. I've made several angel round investments and things that they'll either go to the moon or they're going to become a complete donation, right? Some very interesting investments that I've made. But again, for me, I had the discretionary capital to be able to do that, right? Not everybody does. Those are really, really risky investments. Okay. I, for example, invested in cryptocurrency in 2016. I killed it. Okay. Because of the time that I got into it. But I also my risk profile, okay, is a little bit different than maybe the average individual that wouldn't have been able to or wouldn't have wanted to make a bet like that, right? That could pay off, but it might not pay off, kind of a thing. So I think the important thing for everybody to understand is that you have to have a diversified strategy. Okay. I'm not a Wall Street hater. Okay. I still invest in Wall Street. I still try to find the next Tesla, Facebook, Amazon stock, just like everybody else. I still invest in my index funds. I still deploy capital into a solo 401k, right? But when it comes to alternative investments, I'm very diversified in that space as well. And for me, anyways, the tried and true alternative investment strategy that's by far the boringest of all, okay, is that multifamily B class asset, okay? If you look at that investment, okay, asset and its performance over a 50-year period against any other type of asset class, okay, or Wall Street investment, you're going to find that asset class specifically has the lowest amount of risk and the highest amount of reward, that risk reward profile. Okay. It's going to be the highest out of any one over a 50-year period. Right. And so that's the one that I feel the most comfortable with because I pay myself every single month from those investments. Because every time those tenants pay their monthly, payments, right, a portion of that flows to me, right, and it's tax advantaged. I don't pay any taxes on it because of the power of depreciation, through our cost segregation studies and bonus depreciation rules and so forth.
Love that. Okay, so I want to see if we could do a quick case study and maybe we can pick a property that you've recently it's come to a full cycle and you can walk us through if we were an investor in that property and we put in, we'll just say the minimum 50,000, what were some of the returns that these investors received and what was the time frame from the time of deployment until the time of disposition or refinancing?
Yeah, it's a great question. And I'm going to just kind of give you a number of different possible outcomes. Okay. The reason why I'm going to do that is because I'm going to tell you the truth. Okay.
Absolutely.
Not about the sexy pitch deck. Please understand that. Okay. A number of different outcomes. Okay. What could happen in 2 years from now is we fully renovated all the units and supply absorption strong. Okay. Supply is weak. Okay. It's supply demand economics. Okay. Interest rates, the 10-year treasury falls to 3%. Okay. It's at 4.5 right now, maybe higher, depending upon when we're listening. Okay. Yeah. In that type of an environment, that's going to be a home run deal. Okay. Because you've got the market behind you, right? Your tailwinds, I guess we'll call it, not headwinds, tailwinds, right? You've got the market is strong. Okay. You've got a strong operator that can renovate units on time and on budget. Okay. And you've got an appetite for buyers in the space, buyers like BlackRock, State Street, Vanguard, right? Life insurance companies, hedge funds, private equity firms, right? That are trying to gobble up, maybe at that time, they're trying to gobble up turnkey assets that they can put into their public or privately traded REITs. Okay. So that's a perfect case scenario. Okay. In that case of a scenario, we've had deals, okay, in 17 months produce, I kid you not, a 3x equity multiple and a 70% plus internal rate of return. Okay. We effectively tripled investors' money in less than a year and a half. Okay. That's a grand slam. Okay.
Yeah, absolutely.
And by the way, that time period may never come back again. We may never see a deal like that again. So I want people to understand we sold that deal in 2021. Okay. At the peak of the latest real estate market. Okay. That was a time period where an operator could buy a multifamily property, sit on it, do nothing to it. Okay. And just watch cap rates continue to compress. Right. and make a bunch of money. And they looked great, even though they might have been bad operators, right? The market was in their favor. Okay. So that's kind of like example number one. We hit a grand slam. Okay. Another example is 2 years from now, we renovated all the units. It doesn't make sense to sell because why would we give the next buyer a discount in a down market? But we built up enough equity to do a cash out refinance or a supplemental loan to be able to return up to 100% of our investors' invested capital while allowing them to maintain the same equity level in the deal as when they originally invested. So now they've got a return of capital that they can now use to invest in something different. So now they're effectively using the same invested dollar in more than one investment. Okay. It's
Mhm.
not a taxable event at all because it's just a cash out refinance, right? They're still able to receive their monthly distribution. They still get their equity profit split when the deal ultimately does sell in the future. Okay. So that's like scenario number two, right? Scenario number three is black swan event. Okay. Black swan event could be the global financial crisis, could be 9/11, could be COVID, could be the Federal Reserve Bank, jacking up interest rates by 550 basis points over a 14-month period, which caught a lot of operators off guard that were using, floating rate bridge loans. That's kind of where we're at right now, right? Right
Right.
now is the worst case scenario. Okay. We're living right now in 2008, 2009. Okay. We're living in that time period where operators are being forced to sell because their debt service coverage ratios are below one. They can't even afford their debt payment based upon their revenues that they're bringing in, right? And they don't have enough liquidity at the property level in order to be able to extend out the loan. If they got a 3-year bridge loan, for example, in 21, 22, guess what? It's 3 years later now. Okay. If it was a 3-year bridge loan, you have to solve for that. Okay.
Right.
Well, I can tell you rate caps really expensive right now. Okay. And every day they fluctuate, right? They fluctuate largely tied to the 10-year treasury. So really expensive to buy a rate cap right now. And in some cases, maybe in 2021, they bought the deal at 80% LTV, right? But I can tell you right now, it's not 80% LTV. It's probably
Mhm.
95% LTV. You think the senior lender is going to refi or do a loan modification on a deal with 95% leverage? It's not happening, right? So unless you can go to your investors and get them to commit to continue to partner with you through what's called a capital call, right? More than likely, you're going to have to give the keys back over to the bank. And that's exactly what we're seeing right now, which is why we're in an aggressive attack mode. Okay. There's a deal that we have under contract in Dallas. The seller, okay, purchased the property in September of 22, 3-year bridge loan. Loan matures in August of this year. Okay. They bought it for $48 million. We just got it under contract for $33 million. Okay.
Wow.
The seller is losing almost $14 million of equity. Okay. That's where we are right now in the economic cycle. That worst case scenario that I just painted for you right now, that's now. Okay. You never heard stories like that in 2021. Okay.
Mm-mm.
So that my point is that again, when there's blood in the streets, when there's fear in the markets, okay, that's when Warren Buffett tells people that's when you need to get greedy. Okay. It's not when everybody's making a bunch of money. That's the time to sit on the sidelines or exit, right?
Right.
Yeah.
Yeah. No, excellent, excellent points. And I love your take on it and actually giving people kind of the full picture view, because there are people out there that are only going to show you through rose-colored glasses that, look at the returns that we got. This was a great deal. Like, had you done this? But I think it's always best to know, if you are investing any form of capital, you have to be in a position to be okay if you don't get that capital back.
That's right.
So I would not recommend this strategy for anybody who, if they lost 50,000 or whatever it was that they put in, it's going to cause them significant financial distress. Don't do it. It's not worth it.
Yep, that's exactly right. But I mean, obviously, in some cases, people just fail to take action. There's something called analysis paralysis or paralysis by analysis, and sometimes that causes people just to sit on the sidelines forever.
Oh,
And
absolutely.
if that's your strategy, then the last time I checked, but the value of the dollar has decreased about 20% in the last 4 to 5 years. So you're actually losing purchasing power, every single year because of inaction too.
And, I think that compounds on the fact that most people are not going to have enough money to retire on. And I think deploying alternative investments like syndications, like in real estate assets, is really important for people to understand that, like you said, the value of the dollar is going to continue depreciating. We're going to continue seeing inflation. We're going to continue seeing price increases. And if your investments in money markets or different stocks and bonds isn't able to keep up with that, having a 401k exclusively is not going to be sufficient for you when you enter that point of retirement. And, speaking as a millennial, we've been through now 3 market cycles within our generation. And a lot of people are like, look, I started investing during the Great Recession and lost a bunch of money. And then, then you have that like fear kind of put in your head. And then you're just like, oh, okay, I'm just going to keep it safe, keep it in my 401k. And then you have, another COVID disaster that drops 401ks and retirement plans by 40%. And now we're seeing tariffs and other financial issues, interest rates, and, uncertainty within our markets come up again. And to your point, if you don't actually do something, you're never going to get ahead of the game. And I hate to see people working until they're in their 70s, because that's just, who wants to do that? Nobody wants to work unless you love what you do, because there are people out there that they work because they love it, not because they have to. But most people out there work because they have to. And I think what you're doing, Jeremy, is awesome. I think it provides people with an education on what it means to invest passively. And I would love to be able to help promote some of your current offerings. And so give me an idea of how many, maybe like slots, if you will, you tend to have available for some of these opportunities.
Yeah, they're first come, first serve, right? So when we launch a new investment opportunity to our network, we'll send out all the information a week in advance, right? That way people have a full week to do their own due diligence, phone a friend, talk to Mallory, talk to a spouse, right? But then when we officially open it up for investment, that's when it comes first come, first serve. They do fill up in less than a day. Okay. I had one that actually filled up in 90 minutes. So I would just say, if you're looking for more information, definitely do reach out, to me directly. You can reach out to me at Jeremy@Rise48Equity.com. You can certainly check me out, on LinkedIn as well. Or reach out to Mallory and she can get you connected with me. I did want to just let you know real quick, Mallory, I have a call in 3 minutes with an NFL football player, which everybody in your podcast would know his name. I can't say his name, obviously, on recorded line here, but this has been really a pleasure to meet you. And so I really thank you for opening this up to your audience.
Absolutely. And so we will put a link for your book. Again, do you want to remind our audience the name of your book and where they can find it?
Yep. The Fundamental Investor. You can grab a copy out on Amazon. And again, feel free to reach out to me directly at Jeremy@Rise48Equity.com.
Love it. Jeremy, thank you so much. It's been a real pleasure. And for our audience, that wraps it up for another episode of Inspire Wealth. I am Prof M, out. And for those who want a more hands-on learning experience, check out our online courses at inspirewealtheducation.com. Whether you're just starting out or looking to expand your investment portfolio, I've created step-by-step guides and resources to help you achieve your financial goals. So hit that subscribe button and let's start building your wealth one episode at a time.